Good morning, welcome, and thank you for your attention today. I'm going to jump to something right away. I'm sure some of you are thinking, what's with the jacket? And this is the Nova Scotia tartan. It's been an official part of Nova Scotia pageantry since 1956. You can't buy these off the rack, you have to have them made. Our company, Morien Resources Corp., is based in Nova Scotia. Our head office is in Halifax, and our smaller asset, the Black Point Aggregate Project, is based on the eastern shore of Nova Scotia in Guysborough County. And our major asset, being the Donkin Mine, is based near the town of Donkin on the northeastern tip of Cape Breton. So we're kind of an all-in Nova Scotia company. Let's get down to business. We have three pillars in this company. Number one is the Donkin Coal Mine project, for which you have a royalty of 2%, scales up to 4% as production increases. It's in operation today. We have the Black Point Aggregate Project, which is 400 million tons of perfectly AAA granite sitting right beside tidewater on Guysborough County, Nova Scotia. We have a royalty on that. We can't disclose what it is, but it's sort of in the dimes per ton, I'll say, is a generalization of that. It'll pay us somewhere between $250,000 and $750,000 a year when that project goes into production. This is no small gravel pit. This is $100 million to build this. And then our third asset is our corporate allocation strategy, and we're very, very focused on managing both sides of the balance sheet, and we'll come to that a little bit further along, but I think we're one of the most disciplined mining companies in the world, certainly in Canada, about how we treat our balance sheet. We mean business. We have three things that we want to do. We're paying a dividend today, and we'd love to increase it, and as soon as these projects increase their production, which they're doing, we'll plan on increasing the dividend. Secondly, we want to add to our portfolio, but we're not going to go and chase gold, silver, diamond projects like the other 50 companies that do. It's too competitive for us, and we're too small. So we're looking at interesting little things like granite quarries in Texas and other little assets like that that aren't hotly pursued, where we could work with the owner and get a royalty from those. And these are typically very long life royalties, which is an important part of our acquisition strategy. And then lastly, and this is one of my more favorite things to do, we increase shareholder value because we buy back stock. And so we're always happy to separate somebody who doesn't want to own Morien from their shares. We buy them back into treasury because that means the pie is divided into fewer pieces for those of us who are the remaining shareholders, and that's value accretive. If I can buy a $10 bill for $5, I'll do that all day long, because at the end of it, I'm going to have a bunch of $10 bills. And that's what normal course issuer bid does. I think that this forum, I look at it as being a competition. In the next 2 days, you're going to listen to 40 presentations. And the winners of this competition are the companies that you're going to wake up to on Monday morning and remember, because I'm pretty certain that everybody in this audience isn't going to remember all 40 presentations. So we position our company to hopefully be memorable on Monday or Tuesday or whatever next week. And I want to go through 4 or 5 slides that I hope help to define our company for you. And also, I'd like for you to measure this against the other companies. First off, our G&A costs are down 38% since we took control of this company 5 or 6 years or so. Secondly, our common share count is down 13% since 2015. That is our normal course issuer bid, actively at work, buying back stock at substantial discounts to the net asset value of the company. The management and director ownership has tripled since 2013. So we're putting our money where our mouth is, and we're buying shares, and we're holding them. And our shareholder count is down by 50% since 2013. This is a statistic you don't see offered very much, but it's important to us, because if you have lots of shareholders with lots of stock, when bad news happens, shares get pounded. When you get some good news, people take advantage of liquidity and sell their stock into the market. We have a very tight shareholder group, and our observation and conversation with our shareholders is that there's some that are losing shares, they're selling them. Existing shareholders are adding to their positions. So we're going to have an ever-increasing amount of stock owned by a smaller group of people. That means the stock is tight, and when the good news comes, the stock moves up more aggressively than it would if there was a bunch of people ready to flip their stock into the market. So it's concentrating. It's a great statistic for us. Here's something you won't see much. We're probably the only company here that ended the year with more cash than we started the year, and we had fewer shares along the way. We didn't issue shares. So we have more cash after a year than we had at the beginning of the year. So when you think about Morien on Monday morning, think about these measurements about how we're running this company, because we think we're quite different. Let's take a look at the coal markets. Seaborne coal trade is up 3%. For those people telling you that coal is dead, they're wrong. Seaborne coal is going up. Why is that? We have a growth in global energy demand. All the developing world wants to live like us, and they need energy to do it, and coal is part of the supply chain for that world. Here you can see the black piece in the middle is coal as a percentage of the total energy output. And what you see as you move across those bars is that there's other supplies coming in. Coal is being reduced. Well, it's being reduced as a percentage because there's new entrants into supplying energy. But what's happening is coal is still growing in its consumption, in its usage. It's just that there's other sources coming in. We all like the growth in the natural and renewable energy things. And here's a graph that points to some very encouraging statistics about renewable energy. Up 13.9% on a compounded basis over the last 15 years. That sounds good. Here's the truth. It's tiny. And look at the bars for natural gas, coal, and oil. They have the same rapid slope on them. So as energy demand in the world increases, the most increasing part of supplying that is renewables. But the renewables can't keep up with the energy demand increases for the planet. All the other ones are backfilling in. So there's more energy coming out of coal, oil, and natural gas increasing. They're feeling a bigger part of the energy demand increase than the renewables do. So renewables is a nice story, but it's not particularly meaningful in the world complex of energy. It's coal, oil, and natural gas that are fueling the growth of the planet. Metallurgical coal, you need to have metallurgical coal to make steel. Every ton of steel takes 0.7 tons of met coal. So think about all these buildings that are going up, all these pipelines being built, all the ships being built, all the use of metal. Every ton of that takes 0.7 tons of coal. And the graph at the bottom shows you the growth in metallurgical coal, steel, which leads to metallurgical coal consumption. Protected to grow again as well. The planet's not slowing down. We continue to grow. We need more energy. We need more steel, which means we need more coal. Here's a picture of the Donkin Mine. You hear about other companies that have coal mines. In Canada, Teck's got some and others have some. We've got the biggest resource going. We're the tiny company with the big mine. We have a 30-year mine life, which others don't. We're a very long life in that mine. The Donkin development phase is in full stride. So a little bit of mining 101. When you have a coal deposit, you send a mining machine down the side of it. And it kind of goes down like a Pac-Man and creates a tunnel. And that's the development phase, and that's what we're in now. Once you reach the end of that piece, and that piece is several kilometers long, you send down like 3 more Pac-Men. You put a conveyor belt in the tunnel that you did, and those 4 Pac-Men chew their way home. And all that coal comes back out the one tunnel that was built down the side. So that's the production phase. So we're in the development phase now, which means they're working their way to build that tunnel. It's several kilometers long. Sometime towards the end of this year, they're going to send the other Pac-Men in, and then they're going to chew their way home. And that's when your production really goes up. And so you see in this graph, the development phase is low production. That's the 3 bars on the left. When they get into full production, you get the tall bars on the right, and you get 25 or 30 years of those. If you take a look at now we have a royalty, 2% of the first 2 million tons, 4% of the balance. If you take a look at the royalty we've received so far, it's been sort of close to $1 million over the last couple of years, development phase. When they go to the production phase, that royalty is going to go up between $6.5 and $11 million a year. This is on a company with a market capitalization of $25 million. I mentioned earlier, but we're serious about paying dividends, and you can see from this graph, and you'll be able to get these slide decks for this, the dividends could get up to $0.10 a share when we get to the full production mode in the coming few years. We're paying a dividend today, and we're one of the highest dividend paying or highest yielding mining stocks around. There's a list of household names that we all have a higher dividend yield in. We're so serious about dividends, we put a dividend calculator on our website. And so you can go on our website, and by sliding some of these bars along, you can get an estimation of what you think the dividend will be according to coal price, production volumes, and the payout ratio that we have. So when we say dividends, we mean it. Royalty companies trade at a premium because they don't have operating leverage in them. They don't have a lot of things in them. They just collect royalties and then reinvest that cash or pay it out as dividends. And so they tend to trade at a premium to net asset value. That's the 1.4 times you see in the bottom of that chart. We don't. We think we trade between 0.25 and 40% of our net asset value. So as people get more comfortable with our coal mine, it goes to production phase, that discount in NAV should reduce and be reflected in a higher share price. So Morien, why do you want to own it? Here's the reasons you want to own it. The Donkin Mine is advancing from the late development stage into the high production stage. We think there's valuation and re-rating potential as people get more comfortable with the mine, and as we start lifting the dividend, that should drive a disproportionately higher share price. Quarterly dividend is tied to Donkin, which is coal prices and production. Coal demand remains robust. We have long life royalties. The Donkin Mine is 25 to 30 years. The Granite project, which hasn't started up yet, is a 50-year royalty. We're focused on active accretions, but we're not out trying to buy everything everywhere. We're very judicious about it. We haven't bought anything yet, but we're getting close on some things. And we keep buying back shares, which means those who sell are giving more value to those who want to hold on. And we think that in about the next 18 months, the Donkin royalty will be about half of what our market cap is today. So again, more reasons for valuation. That's my remarks. Thank you very much.